Welcome back, everyone. Sean Stevens here again with Broker to Banker Consulting, where our goal is to assist you with climbing the mortgage banking ladder. What questions should a mortgage lender ask their warehouse bank? Establishing a warehouse line is one of the most essential functions needed to become a mortgage banker. But what questions should you be asking at time of application or upon renewal? When working with our mortgage banking clients, many are unsure of the important questions to ask when searching for a warehouse line provider. In today's short video, I'll review key issues for you to be aware of during your next warehouse bank discussion. If you've not yet done so, remember to take advantage of our complimentary 30-minute initial strategy call where we analyze your situation and discuss whether a banker transition process is right for you. During this call, we will provide practical expertise and understanding of the loan process for mortgage licensing, investor approval and relations, warehouse bank selection, third-party fulfillment providers, E&O and Surety bond companies, origination strategies, coaching, consulting, and more. First off, what is your warehouse bank qualifying requirements? Under line size, depending on your market and average loan size, will your warehouse bank provide you with enough capacity? Find out what their maximum leverage ratio is, which is your line amount divided by tangible net worth, and if any compensating factors can help increase this line size if needed. For net worth, whether you are a non-delegated lender just starting out, looking to expand to delegated underwriting, or opening up a TPO channel, correspondent net worth requirements will vary among warehouse lenders. Financial statements go hand in hand with net worth, and once you determine the minimum net worth requirements, then confirm whether they will require audited or unaudited financials for approval and those subsequent renewals. If you are required to produce audited financials, then make sure to account for the additional time and cost associated with such. And for experience, some warehouse lenders will be more flexible for newly established mortgage bankers, while others will require a longer track record of being in business, sometimes for multiple years. Next, let's review what are the costs associated with your warehouse line. While this may appear to be an obvious question to ask, it is not always addressed due to the fact many mortgage bankers may be somewhat satisfied with their current provider and do not have time to fully research the details for a proper comparison. Make sure to be aware of key items such as your warehouse line interest rate, shipping fees, advance rates, transaction charges such as funding fees, wire fees, age loan fees, extended dwell time rate increases, and any other charges or costs. Find out what the typical dwell time is for your warehouse line and the costs associated with extending those times if needed. Next, let's review principal curtailments. What are they and when are they required? A principal curtailment occurs when a loan is dwelled on a warehouse line for too long, whereby the warehouse bank requires the lender to apply a payment towards a portion of the outstanding principal balance. A good example of this could be when there's a manufacturing error that prevents the loan from being sold in a timely manner. And because a dwell time would exceed a certain time frame, such as 30, 45, or 60 days, then the warehouse bank would require a principal curtailment from the lender to draw down the balance. Another real-life example of this is happening right before our eyes with the recent closures of FGMC and Sprout Mortgage. For any of those non-QM loans that were funded by correspondent lenders using a warehouse line, which were not purchased by FGMC or Sprout prior to closing their doors, it is reasonable to expect those loans will continue to dwell on the warehouse lines with recurring principal curtailment requests forthcoming. Whether you are a delegated or non-delegated lender, it is always best practice to optimize your investor set so that you have multiple outlets for each loan product being funded with your warehouse line. This will allow you to mitigate risk and help protect your business from the unforeseeable. Although today's content was just a starting point, please tune in next time where we will expand into more details during part 2 of our series on what questions a mortgage lender should be asking their warehouse bank. Now, wouldn't it be nice if there was a blueprint available that would walk you through the steps on how to climb the mortgage banker ladder? Well, that is where we step in to help with our practical expertise and understanding of the process, from mortgage licensing, investor approval, warehouse bank selection, third-party fulfillment providers, E&O and Surety bond companies, origination strategies, coaching, consulting, and more. You can simply use our online scheduler to select a convenient consultation time and let us show you the path to prosperity.